Have you ever considered that the colossal financial upheavals of our time, from the very origins of central banking to today's dizzying economic shifts, might not be accidental? That maybe, just maybe, they're part of a meticulously engineered design.
It's a pretty startling thought, isn't it?
It really is. Our source material today presents a profoundly provocative claim, one that carries incredible weight. It's the idea that a hidden deep state of incredibly powerful financial elites has allegedly engineered every major financial crisis for their own immense profit. That's the huge question we're diving deep into today.
And we're not just talking about, some vague, shadowy bureaucracy here.
No, exactly. The assertion is specific. A cabal of bankers orchestrating the very creation of the Federal Reserve, then going on to trigger catastrophic events like the Great Depression.
Right.
And even being seen as benefiting from recent economic shocks, including what some are calling today's pandemic-fueled bubble.
It's a narrative that, if it were true, it would fundamentally reshape how we understand economic history and power itself. And that's precisely why a careful, objective deep dive into this topic is so crucial, wouldn't you say?
Absolutely. We're talking about claims of immense power, immense influence.
Operating with alleged clandestine tactics well outside the visible channels of public governance.
So, our mission, for you listening, is to embark on a really thorough examination.
Yeah, looking at the historical context, the scholarly arguments, any documentary evidence presented to support these, frankly, powerful assertions.
We want to understand the intricate architecture of these claims.
Exactly. Exploring not just what is being alleged, but also how these alleged mechanisms are actually said to work.
Okay, so how are we going to navigate this? It sounds like pretty complex terrain.
Well, we'll be meticulously sifting through various sources, historical accounts, scholarly interpretations, even modern case studies.
The idea is to extract the most important nuggets of knowledge for you.
Right. Offering a clear, engaging exploration, paced to respect your time.
We'll try to balance those broad summaries with the memorable, specific details that really make the information stick.
Think of it as a shortcut, maybe, to becoming exceptionally well-informed on a topic that often feels, shrouded in mystery.
Definitely.
And I think it's really vital to reinforce our approach right from the outset here.
Go ahead.
Our aim isn't to endorse one side or the other or refute any particular viewpoint.
No, impartiality is key.
Absolutely. We're here to provide you with a comprehensive, impartial overview of the information and the arguments as they exist within our source material.
We want to empower you to form your own well-informed conclusions.
So you walk away not just with a sense of what's being claimed about this alleged financial deep state,
but a much deeper understanding of why these claims matter in the grand scheme of economic discourse and, frankly, public trust.
Exactly. We're illuminating the narratives, we're not validating them.
Okay, great. So, to truly understand these potent claims, we really have to start at what's often cited as the very genesis point, don't we?
We do.
This clandestine meeting that allegedly set the stage for everything that followed. Let's delve into the alleged origins of this financial deep state, beginning with an event whispered about for over a century.
The Jekyll Island meeting, November 1910.
That's that one.
Indeed, this secret gathering on Jekyll Island is often presented as the foundational claim, the patient zero, if you will, for the entire theory.
Paint the picture for us. Where was this? Who was there?
Okay, so picture it. A remote, exclusive island off the coast of Georgia, a private club, very posh, very secluded,
Right.
and a clandestine meeting involving the absolute biggest names in American finance at the time.
We're talking the real titans.
Oh, yeah. Individuals representing families and institutions like J.P. Morgan, Rockefeller, the National City Bank, which was linked to Rockefeller interests, Kuhn, Loeb & Co., which had ties to the Rothschilds through marriage and business.
So serious players.
Absolutely. Figures like Senator Nelson Aldrich, who was actually J.D. Rockefeller Jr.'s father-in-law, adding another layer. Frank Vanderlip from National City Bank, Henry P. Davison from J.P. Morgan and Company, Paul Warburg, a prominent European banker who was a partner at Kuhn, Loeb.
Wow.
The very idea that such titans would meet in absolute secrecy.
Without any public knowledge or government oversight.
Exactly. To discuss the future of the nation's monetary system, well, that immediately sets off alarm bells for anyone who believes in a hidden hand controlling things.
So what exactly do these claims suggest they were conspiring to do there? In secret, what was the alleged agenda beyond just, banking reform?
Well, the official story, the public record, states it was a conference to discuss banking reform. There had been a series of financial panics, like the Panic of 1907, which exposed weaknesses in the system.
Okay, that sounds reasonable on the surface.
It does, but the deep state theory, it zeroes in on two key aspects of that meeting that raise suspicion. First, the absolute secrecy. As I mentioned, they traveled under aliases, used only first names at the club, no press, no public record of the detailed discussions. For proponents of the theory, this secrecy immediately implies an agenda that wasn't necessarily aligned with public transparency or benefit.
Okay, secrecy is point one. What's the second?
The second, and this is crucial, is the outcome. The plan they allegedly hatched there, which formed the basis of the Federal Reserve Act 3 years later.
Ah, the Federal Reserve itself.
Yes. The claim is that they designed a system that, while presented as a public good, allegedly had private interests deeply, fundamentally embedded in its structure.
How so?
Particularly through the private ownership of the 12 regional Federal Reserve banks. The contention is they designed a system that would allow them, this group of bankers, to control the nation's money supply and thereby its economy for their own benefit.
Sort of insulating themselves from financial instability while maybe even profiting from it.
That's the allegation. Now, defenders of the Fed's structure might argue that private ownership was intended to decentralize power, keep it out of purely political hands, provide independent expertise.
But the deep state theorists see it differently.
Completely. For them, it's proof of a private takeover right from the very inception, a system designed by bankers, for bankers, under the guise of public service.
And that alleged design, supposedly conceived in secret on Jekyll Island, it purportedly came to fruition just a few years later, in 1913, with the establishment of the Fed.
Correct. The Federal Reserve Act was signed into law in December 1913.
And this is where those claims about a profit motive really start to gain traction, isn't it?
It is.
Because, as our source highlights, the Federal Reserve wasn't set up as a purely public government institution like, say, the Treasury Department, in the way many might assume.
No, the structure was and is quite unique. It's often described as a public-private hybrid.
And specifically, all 12 regional Federal Reserve banks were initially owned by the commercial banks within their respective districts. These are the member banks.
That's right. The stock in each regional Fed bank was, and still is, held by the member commercial banks in that region.
Okay, so for our listener, let's break this down. When we say these regional Fed banks were privately owned by commercial banks, and that creates an incentive for profit when the money supply expands.
Yeah.
How does that actually work? How does a commercial bank directly benefit if the Fed injects more money into the system or lowers interest rates?
Okay, good question. The theory suggests a few key mechanisms for how these private owners allegedly profit directly from the Fed's operations.
Let's hear them.
Firstly, when the Fed expands the money supply, it often does so through what are called open market operations. This usually means the Fed buys government bonds, like treasury bills or bonds.
Okay, buying bonds. From whom?
Well, it typically buys these bonds from its member commercial banks or dealers who work with them. When the Fed buys these bonds, it pays for them by crediting the reserve accounts of those commercial banks.
So it's essentially injecting new digital money directly into their reserves.
Exactly, purely electronic money creation in essence. Now, these commercial banks have more reserves, which form the base upon which they can create new loans. Under fractional reserve banking, they can lend out a multiple of these new reserves.
Ah, so more reserves means much more lending capacity.
Precisely. And more lending means more interest income for these commercial banks. So an expansion of the money supply directly increases the lending capacity and thus the potential profits of these privately owned regional Fed member banks.
It sounds almost like a direct pipeline of new money flowing into their coffers, which they then get to leverage for profit.
That's certainly how the critics frame it. Secondly, consider interest rates. When the Fed lowers its target interest rates, like the federal funds rate.
Which is often a consequence of expanding the money supply, right?
Often, yes. It makes it cheaper for these commercial banks to borrow money, either from the Fed itself through the discount window or, more commonly, from each other in the overnight market.
Lower borrowing costs for them.
Right. Which tends to widen their net interest margin. That's the difference between the interest they earn on the loans they make and the interest they pay on deposits or their own borrowings. A wider margin generally means more profit.
Okay, that makes sense. So cheaper funding, potentially higher profits.
And thirdly, there's the crisis aspect. In times of financial turmoil, if the Fed acts as a lender of last resort, providing emergency liquidity or orchestrating bailouts.
Like in 2008.
Exactly. The allegation is that these private shareholders, the member banks, are often insulated from the worst losses, or can even profit from the rescue operations and the subsequent market recovery fueled by Fed actions.
It feeds into that idea of privatizing gains while socializing risks.
That's the phrase often used, yes. The interim summary from our source material puts it quite pointedly, as you mentioned. The Fed's origins lie more in private banker interests than in public governance, according to conspiracy claims.
It really highlights that fundamental tension, doesn't it, between private profit motives and a public service mandate, especially at the highest levels of financial power.
And the deep state theorists argue this tension wasn't an accident, but was deliberately designed into the system right from that supposed Jekyll Island meeting.
Okay, so we have the secret meeting, the private ownership structure, the alleged profit motive. But the narrative takes an even more specific turn, doesn't it? It introduces a scholarly debate about dynastic influence.
It does.
It's not just presented as a shadowy cabal of generic bankers, but specific, incredibly powerful historical families.
Yeah.
Our source brings in Song Hongbing's argument from his book, Currency Wars.
Ah, yes, currency wars. Immensely popular, particularly in Asia.
And he posits that the Fed wasn't created by just vague banker interests, but very specifically by identifiable, historically dominant financial dynasties. The Rockefellers, the Rothschilds, and the Morgans. He claims they established it as a private system.
That's right. Song Hongbing's work really elevates the deep state theory. It moves from a general sense of powerful financial interests to a much more focused, almost familial, long-term strategic plan.
So it gives names and faces, or at least family names, to the alleged architects.
Exactly. His Currency Wars series, which became a massive bestseller in China and influential elsewhere, meticulously traces what he presents as a multi-generational plan by these specific families to exert control over global finance.
How does he argue they did this?
He details how these dynastic families, through their vast accumulated wealth, their control over key industries like oil and banking, and their intricate international networks, allegedly manipulated political processes, influenced governments, and even shaped public opinion through media control or funding specific ideologies.
All to establish central banking systems they could control.
Particularly the Federal Reserve, yes, which they could then leverage for their own ends, consolidating their power across generations. He connects events across decades, even centuries, presenting them as steps in this long game.
So he's essentially saying the creation of the Fed wasn't a standalone event in 1913.
No, he frames it as a culmination, a pivotal moment in a continuous generational strategy by these specific families.
Wow. So if we connect this to the bigger picture, Song Hongbing's perspective frames the Fed not merely as a national bank with some private components,
but as a private instrument of dynastic power. The implication of calling it a private system goes beyond just the ownership of regional bank stock.
what else does it imply?
It suggests a system engineered, allegedly, to funnel wealth and influence towards these specific families, perpetuating their economic dominance through every boom and bust cycle. It implies a deliberate architecture designed for generational wealth extraction and control over the global financial landscape.
That's a much more defined, almost lineage-based picture for those making these claims of a hidden power structure. It paints a very concrete image of who is allegedly pulling the strings.
It certainly does. It offers a very specific, though highly controversial, explanation.
Okay, so if that's the alleged foundation, the secret origins, the private structure, the dynastic, influence the narrative, then pivots sharply. It moves to how these shadowy forces purportedly operated during the biggest economic upheavals in history.
Right. Claiming they didn't just benefit from crises, but actively engineered them for profit.
And we have to start with the absolute granddaddy of them all, the Great Depression.
The defining economic catastrophe of the 20th century.
Our source details the documented rapid interest rate hikes by the Federal Reserve in 1928 and 1929. These weren't small tweaks. They were aggressive, almost unprecedented moves for the time.
Yes. The Fed significantly tightened monetary policy, raising the discount rate multiple times in a relatively short period.
And what followed was presented as a direct consequence, a triggered credit crunch.
Can we just clarify what a credit crunch really means in practice?
Good point. What does that entail?
A credit crunch is essentially a severe and sudden drying up of lending. Banks become extremely hesitant to lend money either to each other, to businesses, or to consumers, or they demand extremely high interest rates if they do lend.
So it chokes off the flow of money in the economy.
Precisely. Businesses can't get capital to invest, expand, or even meet payroll. Consumers stop making large purchases like homes or cars because they can't get loans. The whole economic engine just seizes up.
And the sources contend this crunch was the deliberate aim of the Fed's aggressive rate hikes back then.
That is the core of the allegation, yes, that the tightening was intended to contract the economy severely.
Leading to that staggering stock market collapse of nearly 90% from its peak.
An almost unimaginable wipeout of wealth.
I mean, a near 90% market collapse, that's not just a downturn, it's an economic apocalypse. We're talking about a catastrophe that led to over 9,000 banks failing in the U.S.
A quarter of the workforce unemployed at its peak.
Widespread homelessness, breadlines, profound social upheaval, immense suffering for millions.
Just devastating.
And the idea, explicitly raised by scholars cited in our source, is whether these policy decisions leading to such a catastrophe were truly unintentional errors.
Or whether they might have been deliberate. That's the profoundly unsettling thought, isn't it?
It really is.
Because this point is absolutely crucial for the deep state narrative around financial crises. It moves beyond the idea of merely profiting from a crisis.
To actively, deliberately creating one.
Exactly. The sheer magnitude of the collapse, coupled with the Fed's documented swift actions in raising rates just before the crash, prompts that question. Was there a calculated underlying motive behind what looked like disastrous policy choices?
And if one were to follow that deep state line of reasoning, what would that motive be?
The motive, according to the theory, would be to enable powerful financial actors, those allegedly connected to the Fed's creators, to buy up incredibly valuable assets at fire sale prices.
So crashing the market to buy cheap.
Essentially, yes. Consolidating wealth and power during the ensuing chaos. For example, some claims suggest that figures connected to these alleged deep state families had strategically positioned themselves beforehand by holding large cash reserves or perhaps even taking short positions in the market, betting on a decline. This would allow them to benefit immensely as the market plummeted.
And then use that preserved or increased capital
to acquire distressed assets, real estate, factories, companies, stocks, bonds at fractions of their pre-crash value from people who were forced to sell in desperation.
So the depression is framed not as an unfortunate economic accident,
but as a carefully orchestrated wealth transfer, a brutal illustration of the profiting from crises theme in its most extreme form. The argument is that while the public suffered immense losses, a select few were strategically positioned to convert that societal pain into immense private gain.
It's a chilling interpretation of history.
It's deeply unsettling, yeah.
And the claims, as we touched on, aren't just confined to the dusty history books, are they?
No. The source explicitly brings it right up to the present day.
It includes today's pandemic-fueled bubble in the context of these potentially engineered crises. So the theory isn't just historical. It suggests a pattern stretching right up to our most recent global economic shocks.
The playbook, they suggest, remains consistent.
So if that's the case, how do these claims apply to the unprecedented economic events of the last few years? How is the pandemic-fueled bubble seen through this particular deep state lens?
Okay, well, connecting this to the bigger picture, the argument is that events that appear organic, even a global health crisis that seems entirely external and uncontrollable,
like the COVID-19 pandemic.
Exactly, can be either exploited or, in the most extreme interpretations of the theory, perhaps even initiated or deliberately exacerbated to facilitate massive wealth transfer and consolidation.
So the pandemic-fueled bubble is viewed as the latest chapter in this ongoing narrative of crisis as opportunity.
That's how proponents of this view see it. They point to the unprecedented scale of government stimulus packages and central bank interventions globally.
We're talking trillions of dollars, pounds, euros, quantitative easing on a scale never seen before.
Right. Central banks buying massive amounts of government bonds and other assets, injecting literally trillions into the global economy. Now, ostensibly, the aim was noble: prevent economic collapse, support businesses, protect livelihoods during lockdowns.
But the critics argue.
Critics argue that this enormous wave of liquidity didn't just prop up the economy. It disproportionately flowed into financial markets and inflated asset prices.
Stocks, real estate, cryptocurrencies, even things like NFTs.
Exactly. Benefiting primarily those who already own significant amounts of these assets, the already wealthy.
So the average person might have received a stimulus check or two, which Helps, certainly.
But those with substantial investment portfolios potentially saw their net worth multiply dramatically.
Meanwhile, many small businesses struggled or were forced to close permanently during lockdowns.
Right. While large corporations, many allegedly with deep ties to these financial elites or better access to cheap credit and government support, often flourished. They acquired struggling competitors at bargain prices or received significant government bailouts or contracts.
This sounds like what some call disaster capitalism.
It's often framed precisely that way, using a crisis, in this case, a pandemic, to justify extraordinary measures that ultimately lead to a further concentration of wealth and power in the hands of the already powerful. The narrative suggests a consistent manipulative thread.
Woven through seemingly disparate events, the Fed's creation, the Great Depression, the 2008 crisis, the pandemic response.
Suggesting that economic instability, regardless of its apparent trigger, is consistently leveraged by an alleged deep state to expand their influence and accumulate ever greater wealth. It's about seeing a consistent self-serving strategy played out across different eras, using different tools.
What's compelling, or perhaps disturbing, is that this isn't all just theory or interpretation of history. Our source also points to documented patterns of covert manipulation.
Yes, suggesting these tactics aren't just historical whispers, but proven realities in some cases.
The source offers a pretty stark interim summary right before getting into this section, stating, "Then and now, powerful financial actors have used covert tactics to skew markets in their favor."
It sets the stage clearly.
And it argues this isn't just a modern finance problem. We're talking about a deep historical parallel, a cross-cultural one even, ancient Rome and their debasement of coinage.
Ah, yes, the Roman example. It's fascinating because it shows this isn't necessarily new.
How did that work? Coin debasement.
Well, ancient Rome, particularly during periods of economic strain or to fund wars or lavish spending, resorted to debasing its currency. This wasn't just accidental inflation.
What did they actually do?
It involved literally shaving precious metals, like tiny amounts of gold or silver, off the edges of existing coins before recirculating them. Or, more commonly, reducing the actual precious metal content, the purity of newly minted coins, mixing in cheaper base metals like copper, but keeping the coin's official face value the same. Sneaky. So they could produce more coins from the same amount of gold or silver.
Exactly. This influx of debased currency into the economy inevitably led to inflation. As people realized the coins weren't worth as much intrinsically, it effectively devalued the currency in everyone's hands.
But how did the elites profit from that? It sounds like it just hurt everyone by eroding trust and causing inflation.
It certainly hurt the general populace profoundly. It led to a loss of public trust in the currency, economic instability, and hardship. However, the elites in power think emperors, senators, powerful merchants, those close to the mints.
They often had foreknowledge, didn't they?
That's the key.
Yeah.
They knew when a debasement was planned, so they could hoard older, pure coins. Or they could quickly use their soon-to-be debased currency to acquire real assets, land, buildings, grain, commodities, before the debasement became widely known and prices adjusted upwards.
So they converted their bad money into real wealth before everyone else caught on. Precisely. Or they could engage in lending practices, demanding repayment in purer coin or adjusting interest rates to account for the expected inflation, effectively profiting from the currency manipulation at the expense of the common citizen. It allowed for secret profiteering and effectively transferred wealth upwards.
That's a really powerful historical example.
It provides a crucial, non-Western, ancient parallel. It suggests the pattern of powerful elites manipulating economic systems for personal gain isn't unique to modern finance or specific to the alleged American-European deep state.
It's more like a recurring human tendency, maybe. A fundamental dynamic of power and greed.
One could certainly argue that. The tools evolved dramatically from literally shaving bits of gold off coins to using complex algorithms for high-frequency trading, but the underlying human impulse to gain an unfair advantage through covert means seems strikingly consistent across millennia.
It definitely lends historical weight to the plausibility of such manipulation happening today, doesn't it? Makes the modern claims seem less like isolated incidents.
And more like a continuation, perhaps, of an age-old practice. It underscores the enduring temptation to rig the system, then you have the power to do so.
And if you think that's just an interesting but distant historical footnote, well, what makes this claim particularly compelling today is that we have a concrete, modern, and very much verified case of this kind of manipulation.
You're talking about the J.P. Morgan spoofing scandals.
Exactly. Between 2008 and 2016, this isn't ancient history, it isn't theory. This is a modern, proven case of large-scale market manipulation with a massive fine to back it up.
A very significant case, yes.
JP Morgan was caught placing, according to the authorities, thousands of unlawful orders, fake orders, to manipulate prices in the precious metals and U.S. Treasury futures markets.
It culminated in a deferred prosecution agreement and a combined penalty of nearly $1 billion, actually. The source says $1.2 billion fine in 2020, though settlements often involve multiple components. A huge number, regardless.
A staggering amount. For those unfamiliar, can you quickly explain what spoofing actually is? How does it work?
Sure. Spoofing is a particularly insidious form of market manipulation, especially in electronic markets. It involves a trader placing large buy or sell orders that they have no actual intention of ever letting execute.
So they're fake offers.
Essentially, yes. They're designed to create a false appearance of market depth, a false impression of heavy buying interest if they're large buy orders, or selling pressure if they're large sell orders.
Why would they do that?
To trick other legitimate market participants into reacting. If others see a huge wall of buy orders appear, they might think the price is about to go up and rush to buy themselves. Or if they see huge sell orders, they might panic and sell.
So the spoofer creates a false signal to lure others in.
Exactly. Then, just milliseconds before their fake orders would actually be filled by these reacting traders, the spoofer instantly cancels them. Poof, they vanish.
Leaving the other traders holding the bag, potentially at manipulated prices.
Precisely. While the spoofer, having created this false price movement, might have quickly executed their real, often smaller, intended trade at the more favorable price they just induced. They profit from the deception.
So they're essentially sending out false smoke signals to trick the market, then pulling the rug out from under everyone else who reacted.
That's a good analogy, yes. And in this specific case with JP Morgan, it wasn't just one rogue trader, it involved multiple traders, including supervisors like the head of the precious metals desk, engaging in this deceptive practice systematically over an 8-year period.
8 years, wow. And impacting major markets.
Yes, gold, silver, platinum, palladium futures, and crucial U.S. Treasury futures markets. These aren't small niche markets, they're globally significant.
And the authorities, the CFTC, the Department of Justice, they brought serious charges.
They did, leading to that substantial financial penalty, admissions of wrongdoing by the bank, and even criminal convictions for some of the individuals involved.
Here's where it gets really interesting, though, connecting it back. This raises a really important question, doesn't it?
It does.
If we have documented billion-dollar examples of major established financial institutions like JP Morgan engaging in illicit, large-scale market manipulation activities that were eventually caught and prosecuted,
what does that imply about the scope of activities that might remain undetected? Or perhaps operate even more effectively in the shadows, maybe by actors with even greater influence or more sophisticated methods?
it makes the idea of larger conspiracies feel far more tangible, less abstract.
It certainly provides powerful, concrete evidence for the underlying premise of the deep state theory, that powerful financial actors do, in fact, engage in covert tactics to skew markets for profit, while JP Morgan itself isn't explicitly named as part of the deep state in our source.
The case undeniably highlights the fragility of trust in financial systems.
Absolutely. It demonstrates that manipulation, often for substantial profit, is not just a theoretical concern from history or conspiracy circles, but a proven reality in modern markets. It gives significant credence to the possibility of even broader, more systemic manipulations. It makes those more shadowy theories seem disturbingly plausible to many.
Okay, so let's pause and recap where we are. We've walked through the alleged historical plotting at Jekyll Island and the Fed's contentious origins.
The arguments about private interests being embedded from the start.
Right. Then the audacious claims about the Great Depression possibly being intentional, engineered to consolidate wealth. And just now, the documented patterns of market manipulation, stretching from ancient Rome's coin debasement right up to the modern JP Morgan spoofing scandals.
A wide range of evidence and claims.
Our source provides a comprehensive summary of all this, acknowledging the weight of it all. It states, and this is a key quote, historical plotting, documented market manipulation cases, and scholarly claims form a coherent narrative.
It does seem to hang together, doesn't it? The pieces fit into a pattern.
But, and this is the crucial qualifier, lack definitive official proof, leaving the deep state theory in the realm of plausible yet unverified conspiracy.
And that distinction is absolutely vital. It's a compelling story, a narrative that connects disparate events into a single, cohesive thread. It offers an explanation for seemingly chaotic economic cycles, for seemingly inexplicable concentrations of wealth.
It draws on historical facts like the Jekyll Island meeting happening, the Fed structure.
And documented instances of illicit behavior like the JP Morgan case, it creates a very strong circumstantial case, you could say.
What?
But, as the source rightly notes, it critically lacks that definitive, official, incontrovertible proof. You know, the smoking gun documents clearly outlining a conspiracy or verifiable confessions from the alleged perpetrators, the kind of evidence that would unequivocally move it from a highly plausible, albeit disturbing, theory into established, undisputed historical fact.
Understanding the distinction, plausible but unverified, is key for a nuanced perspective, isn't it?
Absolutely. It's a narrative that resonates deeply with many people, precisely because it offers a seemingly logical, even if unsettling, explanation for perceived injustices and inequalities within the global financial system. But resonance isn't the same as proof.
So with all this swirling around these huge historical claims, the documented manipulations, the lack of definitive proof, what does all of this mean for the individual? For you listening, trying to navigate these complex financial waters and unsettling narratives?
That's the critical question, isn't it? How does this affect us personally?
We actually have a powerful personal anecdote shared in the source material from someone identified as Investor A, reflecting on their experience back in 2008.
Okay.
Investor A shared. In 2008, rumors of bank spoofing, interestingly, connecting to what we just discussed, sent me into panic selling. I lost more to fear than to the market crash.
Wow, that really brings it home.
Doesn't it? That story truly highlights the profound, often hidden impact of these narratives and rumors, whether they're ultimately proven true in their entirety or not.
It's a stark reminder that fear itself can be as destructive financially and emotionally as any actual market mechanics or manipulation.
Absolutely.
What's fascinating there is how the perception of manipulation, the widespread rumors, the whispers about covert activities, just the general feeling that the game might be rigged.
That perception can itself become an incredibly powerful market force, can't it?
Absolutely. Directly impacting individual behavior, like Investor A's panic selling, and therefore individual outcomes. Sometimes that fear-driven reaction can cause more damage to an individual's portfolio than the underlying economic reality or even the actual verified extent of manipulation might warrant.
It really highlights the psychological dimension of financial crises.
It's not just about the numbers, interest rates, bond yields, PE ratios. It's deeply about human reaction, reacting to uncertainty, to perceived injustice, and to that deep-seated fear that you might be an unwitting pawn in a system that's fundamentally unfair or manipulated against you.
Understanding that emotional vulnerability seems just as important for your own financial well-being as understanding the economic theories themselves.
I completely agree. It underscores the idea that belief, or fear, can manifest its own reality, at least on an individual level, influencing decisions that have very real financial consequences.
And this leads us directly to a really crucial piece of advice offered in the source, especially when we're diving into such intense, often anxiety-inducing topics like these.
Practical advice is always welcome.
How do we keep our heads when the world feels unpredictable and claims of hidden forces are swirling around us? The source advises, if you're overwhelmed by crisis narratives,
Which is easy to be.
very easy.
Yeah.
Start small, define clear stop losses, and focus on what you can control. Your peace of mind is your most valuable asset.
That's incredibly practical and, frankly, quite wise advice in this context.
It really resonates.
If we connect this back to the bigger picture, this pursuit of knowledge, learning about complex financial systems, understanding theories like the deep state, weighing the evidence, it isn't just some abstract academic exercise.
No, it feels much more personal.
It's profoundly about building personal agency, building resilience in a world that's just brimming with information, and often very conflicting narratives.
So understanding what's being claimed, what's actually verified by evidence, and what remains in that realm of unverified speculation, that helps you define your own boundaries.
Exactly. It helps you maintain your equilibrium, your sense of perspective. And then implementing practical strategies, like setting stop losses in investing.
Can you explain what a stop loss is quickly?
Sure. A stop loss is basically an automatic order you place with your broker to sell a particular stock or asset if its price falls to a certain predetermined level.
So it limits your potential downside.
Precisely. It's a tangible way to manage financial risk, But just as importantly, it helps manage emotional impulses during market volatility. It takes some of the panic decision-making out of the equation.
Because you've already decided your exit point when you were calm.
Right. This kind of advice empowers you to take concrete steps to protect not just your financial capital, but perhaps even more importantly, your mental well-being.
Your peace of mind is your most valuable asset. I like that framing.
It truly is, particularly in volatile markets and a world filled with theories that can easily breed anxiety and fear. It's about discerning what you can influence your strategy, your risk management, your emotional responses.
And drawing boundaries against what you probably cannot influence, like alleged global conspiracies or unpredictable market swings.
Exactly. Protecting your psychological capital in the face of uncertainty.
Now, as we step back a bit and explore some broader implications and cultural analogies related to all this, it's worth noting that sometimes the best way to process really heavy information is with a touch of humor, or at least a dose of relatable skepticism.
A bit of perspective helps, definitely.
The community comments shared in our source material, they perfectly capture that mix of skepticism and maybe frustration that you often hear out there regarding these grand theories.
What kind of comments?
Things like, if the deep state is so powerful, why haven't they left me a bailout check?
Huh. Yes, I can see people saying that.
Or another one, Jekyll Island plot or financial fairy tale. My wallet hasn't received the memo.
That's good. It brings it down to earth, doesn't it?
It really does. These comments are so relatable because they remind us that for many ordinary people, these grand, sweeping theories about hidden power structures, about centuries of manipulation,
They don't always translate into a direct, tangible, personal impact on their everyday lives or their bank accounts.
right, there's a gap between the theory and the lived reality for many.
And they really raise an important question for all of us, don't they? How do we balance that crucial need to critically examine powerful claims, especially claims concerning economic control and potential abuses of power?
With a healthy, maybe even humorous dose of skepticism, keeping our feet on the ground.
Exactly. These comments serve as a lighthearted yet poignant reminder that theories, no matter how compelling or intricately constructed they might be, must still somehow resonate with lived experience and tangible outcomes for the average person to gain widespread, lasting traction.
They highlight that gap between the macro-level narratives of alleged manipulation and the day-to-day micro-level realities of individual financial struggles or successes.
It's about maintaining perspective, acknowledging the diverse ways people react to and interpret such complex, often overwhelming and unsettling information. Not everyone feels the direct impact, or for some, the theory just feels too grand, too movie plot-like to be true, or maybe simply irrelevant to their immediate worries.
That makes sense. And finally, our source takes us to a truly thought-provoking, almost speculative place. It draws a very powerful cultural analogy.
Oh, what's the analogy?
It links these modern economic control narratives, these anxieties about powerful elites managing economies, to a very ancient text, Revelation 13 in the Bible.
Ah, the mark of the beast.
Exactly. Specifically, the warning there about a future system where no one can buy or sell unless they have this mark, it's fundamentally about commerce control.
A very potent and historically resonant image of total economic control.
And the source then directly poses the question, connecting ancient prophecy to modern tech. Could modern digital IDs and central bank digital currencies become the new mark?
Wow. Okay, that is a profound parallel to draw.
Isn't it? It connects historical banking conspiracies and modern financial anxieties to deeply philosophical, even apocalyptic questions about future control mechanisms.
What does this all mean for how we might live and transact in the future? Why is this specific analogy being drawn now with things like CBDCs?
Well, what's fascinating here, as the source implies, is how these ancient doctrines, often rooted in spiritual warnings about ultimate control, about total societal integration under a single power,
They can find new, unexpected resonance with very contemporary anxieties. Anxieties about power, about invasive technology, about economic surveillance, about the potential loss of freedom in a digital age.
it pushes us to consider the long-term implications of current technological and financial trends, doesn't it?
Not just from a purely economic efficiency perspective, but from a profound societal freedom standpoint as well.
Okay, let's clarify for listeners. We hear about digital money all the time. How would a central bank digital currency, a CBDC, be fundamentally different from the money we use now, like the money in our bank account, or even cryptocurrencies like Bitcoin.
That's a really crucial distinction to make. The money you currently have in your commercial bank account, say at Chase or Barclays or wherever, is technically a liability of that private bank. It's a promise from that bank to pay you.
Okay, it's commercial bank money.
Right. And cryptocurrencies like Bitcoin operate on decentralized ledgers, deliberately designed, in theory, to be outside the control of any single central authority.
Right, decentralized.
A CBDC, however, would be fundamentally different. It would be a direct liability of the central bank itself, the Fed, the Bank of England, the ECB. It would be digital cash, essentially, issued directly by the state's monetary authority.
So like a digital version of a dollar bill or a pound coin issued by the central bank.
Exactly. And this shift from commercial bank money to direct central bank digital money for everyday use could potentially give the central bank unprecedented control over and visibility into every single transaction made with it.
Unlike physical cash, which offers anonymity.
Precisely. Cash allows for anonymous transactions. A CBDC, being digital and centrally issued, would theoretically allow for full traceability of every payment. The central bank could potentially see who paid whom, for what, when, and where.
That's a huge increase in surveillance potential.
Immense. Furthermore, and this is where the mark of the beast analogy really gains traction for critics, CBDCs could potentially be programmable.
Programmable, what does that mean?
It means the central bank, or the government through the central bank, could potentially embed rules directly into the money itself.
Like what kind of rules?
For example, they could program money to expire if it's not spent by a certain date to encourage spending. Or they could potentially restrict money from being used for certain types of purchases deemed undesirable. Maybe excessive gambling, maybe sugary drinks, maybe ammunition, maybe carbon-intensive travel. Or they could link spending ability to social credit scores or vaccination status. The possibilities are vast and, for many, deeply concerning.
So the analogy to a mark controlling commerce becomes deeply unsettling because it implies
Potentially no more anonymous cash transactions, and the possibility of direct programmatic control over how, when, and on what you can spend your own money. It could limit economic freedom and individual autonomy in ways previously unimaginable.
it moves beyond just the manipulation of markets that we discussed earlier.
To the potential control over individual commerce itself, right down to the level of a single transaction.
So this connection encourages us to look beyond the potential convenience or efficiency benefits that CBDCs might offer.
And to seriously contemplate the potential downsides. The risk of increased surveillance, the potential for social engineering through programmable money, and the fundamental questions it raises about privacy, autonomy, and the relationship between the citizen and the state in a hyper-digitalized future. It's a very heavy, speculative, but important dimension to consider.
Okay. We have covered a massive amount of ground today. We've taken a deep dive into the compelling, sometimes really unsettling claims surrounding a deep state and its alleged role in engineering financial crises.
We really have. We've explored the alleged historical plotting starting way back with Jekyll Island and the Federal Reserve's contentious origins, detailing those arguments about how private interests were purportedly embedded right from the start. We then moved to the audacious claims surrounding the Great Depression, the idea that it might have been an intentional act to consolidate wealth, not just a policy mistake. And we examined those consistent patterns of market manipulation, providing examples from ancient Rome's coin debasement, all the way up to the very modern, documented J.P. Morgan spoofing scandals.
It forms, as the source said, a coherent and powerful narrative, drawing from these historical accounts, scholarly arguments, and documented cases.
It does, but, and it's worth repeating, it's crucial to reiterate that definitive, official, smoking gun proof remains elusive. This leaves the overarching deep state theory as a grand, unified explanation firmly in the realm of plausible yet unverified conspiracy.
It's certainly a lot to take in, isn't it? And as our source reminds us, offering a really powerful, overarching thought to consider as we wrap up, evil grows not from thin air, but from our unchecked fears and blind trust.
That's a potent statement, and it resonates deeply with everything we've discussed today, doesn't it?
It really does. It doesn't feel like just a philosophical statement in this context.
No, I think it serves as a profound call for internal vigilance, not just a warning about potential external forces. It urges us, perhaps, to cultivate critical thinking.
To question assumptions about how our financial systems operate.
Yes, and to avoid falling into either extreme, paralyzed by unchecked fear about unseen forces and conspiracies, or lulled into a state of blind acceptance and trust in institutions or narratives without proper scrutiny.
So true understanding and maybe personal resilience in the face of these kinds of compelling narratives comes from informed awareness.
Informed awareness, critical thinking, and avoiding those unexamined reactions, whether it's fear or unquestioning trust. It even asks us, maybe, to consider how our own cognitive biases and emotional responses might make us susceptible to manipulation, whether by an actual deep state, if one exists, or simply by the powerful idea of one.
So the big question remains, is the deep state myth or reality? Is it a meticulously orchestrated global conspiracy controlling financial events for generations, or is it a compelling narrative spun from a potent blend of circumstantial evidence, genuine instances of manipulation, human psychology, and interpretations of historical facts?
The verdict ultimately has to be yours to decide, based on your own evaluation of the evidence and the arguments.
What will be the next sign for you? The next piece of this puzzle that you choose to explore further? We really encourage you to continue your own exploration, to dig deeper into the sources or topics that piqued your curiosity today.
Keep asking questions.
Absolutely. Join the conversation and share your thoughts with us online. Thank you so much for joining us on this deep dive into the complex, sometimes hidden forces shaping our financial world.